everybody. Welcome to Friday, another Talk Money with Tom show. We're here to try to help you with your retirement. Really excited about today's show. What we try to do here is answer questions. So if you want to send in questions now, you can. You can do that either through email. Here's the email address, asktom, talkmoneywithtom.com, or put it into chat on the channel here itself, and we'll try to answer those live. We've got some questions that came in this week. We've got questions that come up during our strategy sessions with our clients that we'll present today also. So again, this channel is here for you. It's a free resource. We just feel like there's not enough education in the area of retirement, and maybe even in the area of how to manage your money in retirement, or how to manage your taxes in retirement, those types of things. So you can subscribe to the channel. You can hit the bell button to get notified when we put new content out. And so, we have a video that we just put out on, 7 myths of Medicare, right? That was pretty well received, and things along those lines. We're trying to help out here as much as we can. And of course, if you have questions, on a personal basis that you want to ask and don't want to send it into the show, you can just set up an appointment to meet with Eason and I. And again, that's the book appointment button is up in the corner of our website, and it's, our schedule is live, so you can pick a half-hour time to meet with Eason and I here in the office, on the phone, video, whatever works for you. And so anyway, that's our show. I like to start off the show with a kind of a rundown of what we saw happen this week in the stock market. And boy, every week we've been talking about this. There's been plenty to talk about. I mean, it's pretty amazing. There's a lot going on, and a lot of things that are happening. So I'll start with the typical chart here. You can see this again going back to 2018, at the end of 2018. That first dip there, that's right over the Talk Money with Tom sign, was the last time we did some tariffs. So I try to keep that in there so people can see. You can see here just, recently the market's down this week, right? And there's several different reasons. So this is kind of march through the week and talk about what happened here. So first of all, after hours on Friday, Moody's, which is one of the rating companies, decreased the U.S. debt from its highest level rating to the next highest level rating. And so, the market was responding negatively to that in the morning on Monday, but it actually ended up in the end. And part of the reason is because there's 3 rating companies, Fitch, S&P 500, and Moody's. And Fitch and S&P 500 already lowered the rating some time ago.
It's been a long time for those two, I think.
Yeah, I think the first one was 2011. The market dropped like 6-7%, someplace in that range when that happened. But in the end, it doesn't really mean much. It does mean something in the theoretically that you would pay a higher interest rate, because you don't have as high a rating, as far as that goes. But the market forces have more to do with what interest rate you're going to pay overall, in my opinion, than the ratings do as far as that goes. So I think it was kind of a non-event, although it turned into be something that added to what happened this week. So because we're going along, and all of a sudden on Wednesday, the market's falling really hard. It was down 1.6%. And what had happened was that there was a 20-year Treasury bond auction, okay? And so, just so you know, a Treasury bond is an obligation for the U.S. government, and it's essentially a way for the government to borrow money, right? So you put out a bond, okay, we're going to pay you a certain amount of interest for a certain period of time, in this case 20 years, and they all go out to auction. And so is the auction, well received or not? And if it's not, they generally have to raise the interest rate that they're willing to pay. Essentially, this is a market force that does this. And so it was perceived as a pretty soft auction. It does happen, even, because you could make some arguments for why it's happening now, and we'll talk about that. But it has happened before. I do pay very close attention to the Treasury bond auctions and what's happening there, because I think it's one of the most important components of the financial system. We have a country, in this particular case, that's running a deficit. So that means that, we have less money coming in terms of revenue than we have going out in terms of expenses, and we fill that gap by selling these Treasury bonds. And you also have to re-up those Treasury bonds so as they come due, and so that's a big issue that's happening right now. About a third of the Treasury debt is coming due the first half of this year.
Yeah, and each year the interest cost is just getting higher and higher and taking up more and more of the budget.
Yes, and that's one of because even if the interest rate stayed the same, which they're going to go up here, especially on that third of the debt that's coming due now, but even if it stays the same, if you continuously add more debt, you're going to continuously have more cost. And yeah, it's sort of a spiraling piece of the deficit. I forgot the percentage of the total, that of all of our, expenses, how much goes to interest on Treasury debt. You can look it up. My gut feel was some in the 7-8% range, but it could be higher than that. So that was happening on Wednesday, and the market's dropping. Also on Wednesday, that didn't really help the bond market, especially, and ultimately the stock market, was the fact that they're working on this tax relief bill. And the point that they were working on at that point in time is what called the SALT, which is the SALT is basically your state and local tax, I think, something like that. Is that what it stands for? Mm-hmm. And what that is that we could always write off all of that. So you could write off your property taxes, you could write off your state taxes, and then in 2017 they capped that at $10,000. And so now they want to move that up, and so they did decide on Wednesday, or at least so far, 40,000 was going to be the new cap. And if you made 500,000 or more, that cap would start to diminish. You would not be able to take as much write-off, and so. But it added a lot, 900 billion, I believe, to the overall cut in taxes. So that means you got to find that the savings on the other side. So, but at the time, they just added to the deficit, basically. Mm-hmm. So the Congressional Budget Office, the CBO, had the deficit for a 10-year period with the bill in that manner set at $3.8 trillion. And so the bond market's starting to kind of freak out because that's where that money's coming from. If there's $3.8 trillion on there, that money's going to come in the sense of the U.S. selling these treasuries to try to, sponsor that. And look, everybody knows this, especially the bond market. What they're saying is a projection is almost always lower than what it actually ends up being. Because I remember in 2017, that was supposed to be more or less a revenue neutral situation. It wasn't. And again, both parties are guilty of this. You have to use this reconciliation process to get it through the Senate with just 50 votes instead of 60 votes. And so you take a 10-year look and you match up the expenses, that you're going to have, or the revenue you're going to lose in essence, and then where you're going to save that money. And theoretically, those are supposed to get pretty close together in order to get through this reconciliation process. And so, that's happening. And if we look here, you can kind of see, here's a more year-to-date daily look. And you can see where the market is kind of keeling over there, right? Mm-hmm. And so we had this nice run that was going from, the China resolution, getting it down to 30%, and now it's more focus on this tax bill. Well, Wednesday night after the markets closed and Thursday morning, they actually changed the tax bill to increase the savings, okay? And they brought the projected deficit down from 3.8 trillion to 2.3 trillion, okay? Now, the way that they did that is that they had the Medicaid cuts starting when Trump left office, basically, so that the pain can happen after. So got 4 years of that 10-year period, no Medicaid cuts, and then Medicaid cuts start after that. Okay, so what they ended up negotiating is that the Medicaid cuts will start sooner. Okay, and I've had some clients say, "Well, why is that good?" It depends on your perspective. Unfortunately for me, I'm an advisor to a wide spectrum politically of clients. I've got clients who think that it's awful that people are losing their Medicaid, and I got clients that think it's a pretty good thing. So I'm not making political or social commentary. I'm talking about what the market's looking at. And what the market wants to see is less deficit, okay? Because we're already at a pretty high deficit. Adding more to it is scaring the bond market. And so nonetheless, what happened was that they ended up making it so it will start, instead of 2029, it'll start by the end of 2026. Mm-hmm. So that's very interesting. Think about that. What happens in 2026?
So basically after midterm.
Yep. So they're going to have the Medicaid start. I will say that, it's not popular, definitely, on a poll basis. And so they're trying to, keep away some of that pain from their midterm chances. But nonetheless, when we look at the actual bill itself, the market did, seem to like it more. Today, what's happening is we're reinvigorating the tariff war. Two things. Number one, 25% tariff on Apple products if they don't make them here, because they were moving production for U.S. products from China to India, and Trump doesn't want that to happen. I don't see a way that even 25% is going to sway Apple to move here, just because the cost would be pretty prohibitive. But I think one of the problems with all of this has to do with the timing, right? So how fast are they supposed to be able to do this? I mean, are they putting a 25% tariff now? Because we're years away from being able to build an iPhone here in the U.S., even if we wanted to, just because, I mean, all the parts are made in other countries and what have you. So, it's going to be an interesting battle there. We'll see how that plays out. But then also, they paused the tariffs, right? The big tariffs from Liberation Day, and they've been negotiating, and Trump is frustrated with the negotiations that are going on with Europe, and so he's now threatened a 50% tariff on Europe starting June 1st, which is pretty soon.
Yeah, a weekish away.
Yeah, so the market's down. Is it back up? It was coming back. It was down like 1% and it's starting to come back up. I think one of the things the market's starting to realize is that this stuff, if it really matters, like it did with China, they back down. And so, if it's just talk, I think you're going to see the market ignore more and more and try to focus on, like what really matters, what's really happening as far as that goes. I'd say the budget deficit is more of an important component than what they're arguing about with tariffs. Is it back or no?
It's dropped around 0.6 now.
Point six. Okay, so it was almost back to even before the show started, and it's coming back down again. Probably people taking some risk off the table before the holiday too. So let's look at some of these things. So first of all, here's something important. The market got back up almost to 6,000 points. And I was talking about this week, there's a pretty good chance that it bounces down off of that. So if we ignored all the news and didn't even know what was happening, and I looked at that chart, I'd say, yeah, that makes complete sense to me. There's a lot of overhead resistance. You can see where the market spent a fair amount of time right above that period. So a lot of shares are accumulated there. And again, the idea behind support and resistance is that now that I got back, let's say I bought at 6,000 and I'm down, got down to 5,400 or whatever, and it gets back to 6,000, I'm pretty happy. I might take my money back, right? That's the idea behind that. And so then it takes time. You kind of have to bounce against that to absorb all those, institutions or people or shares that are out there that are going to be for sale at that price, right? As people try to get their money back. And then maybe if you're still going upwards, you'll crack through that. Right? Now, what if you're still going downward? Well, there's a couple things that I watch for. Number one is, do we get, back below this high? Because that was kind of a big deal. We started to reestablish, a primary trend to the upside here, at least temporarily. And so does it hold that? Yes or no? We'll see. We're really close to it, so maybe not. And then, maybe most importantly in terms of trend watching is just, do we set a new lower low? So there's one, right? Do we go below that point? And then we're back into, hey, primary direction is still down, and you could basically go back to the beginning here and say, hey, this is just a false move. We got a lot of these false moves in 2022, big ones. This is almost 20%, I believe, recovery. We had an 18% one in 2022 that ended, I think, August 16th, as I recall. And so, these things happen as far as that goes. Let's look at a couple things here that I think are interesting. This is an iShares U.S. Treasury Bond ETF. I like this ETF to follow the overall Treasury bond market because it goes from 1 to 30 years. It's weighted roughly like the overall Treasury market. And so this is month to date, okay? So what you're seeing here is the value of the Treasuries are falling, right? And so it's a huge deal. It's a really, really important thing that we be able to continuously sell Treasuries, especially in the next big downturn. Because in the next big downturn, we need to be a country that people want to go to for safety. They want to buy our Treasury bonds because we're going to have other countries that own our bonds now that might need to sell them because they're having their own situation during this overall meltdown that could be happening. We may want to do stimulus things like we did in 2020 and 2008. And again, we have to be able to sell treasuries to do that. So when you look at this chart, you say, okay, that's not good. We're going the wrong direction. However, I will say a couple things about this I think are very important. Number one is right over my shoulder here is the low point that happened on Wednesday, right? And then 2 days now since the passing of the bill with the House, the bond market has been going up, okay? It's been going up. To me, what they're signaling is the $2.3 trillion deficit that's in that tax bill and all the other components of that tax bill are okay with the bond market. That's incredibly important. It's only 2 days. We'll see how that plays out. The bill's not done, but it's not what was happening as they were talking about it before with the higher deficits built into the bill, okay? Now, here's the second thing. Let's back up a little bit and take a look and say, okay, here's year to date on that same thing. Now look at it, right? So you got to be really careful taking these things out of context because really we were just coming off of a high that's in a range. We had these two peaks, and we're more or less back into the range, right? We're a little bit on the low side of the range. There's some reason to watch this, but we're not even back to where we were, back at the beginning of the year. So, okay, Treasury bond market isn't as scary as everybody's talking about. I will say it's a little different on the very long end of the bond market, the 30 years above 5%. That's not very common. And that's usually associated with some trouble as far as that goes. So there's some things to watch here. But overall, the bond market isn't that scary looking to me when you look at it, at least, even year to date, which isn't very long term to look. The same thing's happening with the dollar. So here's the dollar year to date, right? This is DXY is the dollar against a basket of currencies, right? So coming down, the dollar's coming down. And generally speaking, those go together. If foreign entities, countries are selling our treasury bonds, they're moving out of dollars back into their currency. They're selling dollars also, so should be coming down. We saw some of that in the tariff situation. One of the problems that you have that's kind of interesting is when you cut down on trade is one of the things that brings in money into the dollar, into the treasuries. Because I'm a Chinese company, I sell something here in the U.S., I get dollars for that. I might, park that in U.S. Treasury. So China as a whole is the third largest holder of our debt. Japan, I believe, is number one. And so when you reduce the deficit with these countries, there's less money coming into our treasury market. So now, again, let's back this up a little bit. Here's a 5-year look on the dollar. Again, it's below that range right now by a little bit, right? Something to watch. But it's also coming down off of a pretty big high year to date. That's why that chart looks so weird. So again, sometimes you have to back up and have a little perspective on where things are as far as that goes. And so let's talk about what these tariffs mean. I've seen two numbers now, two different studies. One is 14.4% net tariff. The other is 17%. So we're someplace in that range. We were at 25 to 27 was the numbers I was seeing before they reduced the tariff on China from 145 to 30. What's going to happen with that, right? So that's what the Federal Reserve is asking. Does that cause inflation? Where do those costs go? Everybody assumes it's going to make things more expensive. Via the surveys, consumers feel like inflation is going to go up over 6% in the next 12 months. And so, trying to see where it actually goes. We're still in this zone where we haven't even seen the hiccup that's been caused by the no shipping coming out of China for that period of time. So those would be things that we kind of watch for. But there's enough risk here. What's happened is, we've gone from 2.2% tariffs to 14 to 17% tariffs, and we don't know, uncertainty is very high. Matter of fact, I'd say it's probably the biggest risk to the economy is uncertainty. People that are spending money, consumers, businesses, aren't sure what to do. I mean, across the board with my clients, they're spending less money, all of them. They're not traveling as much, what have you. We're seeing, that uncertainty is related to international travel into our country. A client told me, he flew to England, full flight to fly there, half a flight on the way back, right? And he says he's from England, he's been there lots of times. He says never seen that before. So, how does that impact the overall tourism industries? And so what are these impacts? So, we had 63% in the stock market exposure across all of our clients. We reduced that down to 22%, and we're down back up to 46%, and we still haven't gone all the way back up. And that's because of these uncertainties. And, this week it's probably paid off, right? T-bills, this is what a T-bill looks like, right? T-bills are go up every day pretty much, right? And certainly this week has been down. I think long term, one of the things that's getting ignored here is how much amazing things are happening in the area of technology with artificial intelligence, quantum computing, and all these areas. They're kind of getting buried by these storylines of tariffs and tax cuts and Medicaid cuts and all those types of things. So I think there is some really amazing things percolating along under the surface here that they were getting attention, right? And we got a big bump out of that in 2023, 2024. We saw NVIDIA doing so well. We saw all these things. And now they're getting kind of buried, but they're still happening. There's still money coming in there. These AI companies aren't even having to go public because there's so much private money coming in, on a funding basis that they are not needing to go public to get money. And so there's some reasons to be in the market, but we still have 13% of our money in T-bills, ultra short-term bonds, money markets, combination of those types of things. And it's just to be a little bit cautious here because this is pretty unprecedented, and just kind of what we're dealing with. And so we'll see how that plays out. But pretty fascinating week. I mean, incredible. Soft Treasury thing, a downgrade on the Treasuries, the different, pieces of the tariff war that's firing back up here on a Friday, and that kind of stuff that's been going on. It's still pretty credible time frame to be looking at the market and trying to figure out what is going on here, and worse, trying to figure out what to do. This is probably the hardest environment I've seen in trying to figure out what to do. In 2008, we did quite well in that time frame, but that was like a normal economic downturn. You could see the dominoes falling, could maybe even predict where some of the other dominoes were going to fall. 2000, that was just a overbought bubble, PE of 45 on the S&P 500 at one point in time. This is a small group of people deciding whether we have tariffs or not. And so, if you looked at tariffs and said, wow, those are high, well, they could change tomorrow. As a matter of fact, they did. Over the weekend, 2 weekends ago, the tariffs on China dropped from 145 to 30. And, whatever our net tariff is, if it starts to bring down the economy, I think they'll lower them, right? And so, however, there's still this risk that they might not be able to control everything that happens. What if Japan falls apart and defaults because they're having some problems right now? What if China, who's already having problems, who's now probably even having more problems, what if they default or have issues? So our stock market's not going to survive those types of things. And so when you put the world economic system, financial system under stress like we're doing now, there's just that risk that's out there. And that's what Jamie Dimon was running around talking about this week. And he's the one that was running around in 2008 talking about very similar things. So, I think a 13% holding outside the market right now kind of keeps our powder dry and gives us a chance, if the market does come down, to maybe get in at a lower point. But otherwise, it's just kind of protecting the asset base. Yeah. Okay. So that's a summary for this week. Thank you for joining me for that part. Look forward to, again, discussing that again next week. But let's get in some of the questions.
Should I hold any weight on Trump's EU tariff comments?
Yeah, it's kind of interesting because if you look, right, the market was down 1% and then it rallied back up, and now it's kind of rallying back down again a little bit. I don't think so, personally. Just based, we've now got a little bit of data. I felt like there was panic around the tariffs at China as they went on for almost 5 weeks altogether. And you started to see the shipping dropping off and all that. And so, you can threaten that, you can make it happen for a while, But unless you're going to keep it, then why would the market care, right? And that's one of the problems right now. If you're going to keep a 50% tariff on Europe, we're probably going to have at least a recession. We just are. I mean, but we don't have to. That's the one. Tariffs are optional, and so they can change. And so I think that's what the market's going to start to realize here is that these are, he's negotiating, fine. It's a tough thing for the market to swallow because there's always the possibility that, first of all, something breaks in the overall world economy because of these situations, which kicks us into recession, those types of things. But in terms of the actual, likelihood that we remain at 50% tariff on Europe, it's not very high, right? So I don't think the market is going to be too concerned about that here in the short term, especially. I will say it's a little disappointing because I feel like this turbulence that we're in and the uncertainty that it's causing for consumers and for businesses in terms of where to spend, is it going to end? Right? I mean, is it going to end? You think, okay, these things are just paused. They're still negotiating. So I guess that's the one thing where I pay attention to these comments, both these EU comments and the Apple comment today, right, about the 25%. It's like, well, this is not going to be over. We're going to continue to have these conversations and these threats. And this continues the uncertainty that the businesses and consumers are going to have to deal with. It does have that possibility of kicking us into recession, and you can play around with this for a while. The economy was strong at the beginning of all this, so we have some room to push on it, right? But you got to be really careful here. And so that's where I would put a little bit more weight on the comments, not so much in the overall view of what would happen between the U.S. and EU on a tariff basis, but the overall, it's the uncertainty. We're not allowing, the uncertainty is causing the potential for our treasury bond market to have less sales, right? We saw that this week. So that's where I think that weight would be placed on it, and just kind of, it's pretty tiring dealing with the tariff situation and trying to keep up. I mean, I'm spending a lot of time reading about what's happening, and there's a lot to read. And so I wish it was over. I wish we were done. Let's just have a tariff. Let's see if it works. Let's give it a chance to see if it works at all. They're talking about a deficit here that from this tax bill. Tariffs, if they actually worked in some form or fashion and didn't kill everything, could help pay that deficit, right? So I'd say there's not a great chance of that happening, but it could. And so, I think we're fooling ourselves if we say we really know what's going to happen. But it'd be nice to have a tariff that was solidified and not to think, okay, we're at 14 to 17 right now. We could be anywhere in the future. How do you decide how to invest in that environment?
Yeah,
as an
I think
investor?
the consumer and business are running into that same issue is with so much uncertainty, how do you make a move? How do you plan for your future?
Right.
Do you just, a lot of them just have to stay pat in a sense, and
Right.
you can't really make any kind of investments.
Yeah, if my clients are any indication, and I've been meeting with them, day after day after day, we're looking at a pullback here. I mean, I'm telling you, there's a lot less money being spent by my clients on everything. They're looking at being more conservative with their money. Even just having your account statements dropping, kind of makes people do that. But in this particular arena, and different people that have businesses that I know and CEOs that I've talked to, they're complaining about the uncertainty and complaining about not knowing, what to do and which direction to go. And, if you happen to have an import business that's importing, and boy, that's really crazy, I mean, so there's like this huge thing where they're all running out to buy from China right now because China's tariff is just on a pause, technically. And so we're going to buy up, buy everything for Christmas and all. And so I guess the number of orders tripled pretty much overnight. Well, what if the tariffs go even lower and you look back and you think, wow, it's actually now at 10% instead of 30. I paid 30 on all that stuff. And if I waited until the summer when I normally order my Christmas stuff, I could have got it at 10. Right? So that's really tough to deal with as far as that goes from a business standpoint. And I don't know, sometimes it actually stimulates business. We saw that before the tariffs. Now China's seeing a run on their goods, right? So who knows? It's hard to say what's going to happen here. It's a tough scenario. And I guess that's the main takeaway from the EU tariff comment today was just sort of the disappointment that, this isn't over. I knew that somewhere in my brain, but I was just hopeful. All right. What's the next question?
So, what are your takeaways from the House tax bill?
Yeah, it's kind of interesting, right? I mean, personally, I wouldn't do it the way that they're doing it. It seems more fair if it's just a cut across the board, And so, hey, we're gonna the current tax brackets that we have now sunset. If they don't sunset, it's a massive tax increase, right? However, keeping those costs $4.5 trillion for the next 10 years. Okay, you can't get 4.5 trillion out of the normal things that you might cut, and so now Medicaid, close to $1 trillion worth of Medicaid cuts are on the table, and I would prefer that it was across the board. Social Security Department, all 5-10% cuts everywhere, because the average American gets the fact that we're running a deficit, and nobody does that in their own household without running into problems. You can't borrow $1,000 a month on your credit card forever, before you start to have problems and end up in bankruptcy, and that's the concern here. And so I think if you went out and you were more even across the board and say, hey, we're gonna reinstate these tax brackets, but they're gonna be a little bit higher. And maybe there'll be a tax for the million and above, and so that we can kind of even that out instead of pushing the pain so heavily into really the lower 20% of the earners are going to take it in the chops here between the lack of tax cuts that they get and the increased. They're more susceptible to the increases of costs, and they're more susceptible to using things like Medicaid as far as that goes. However, from a pure stock market standpoint, the tax bill is stimulative if the deficit isn't so high that the bond market can't help it, right? Can't handle it. And so that's a big takeaway. That's important, at least from the stock market standpoint, no matter what you think about how this works. And I would say one of the things I run across all the time with my clients, you can't really invest based on what you feel about things. You have to invest in the way that the market feels about those things. The market, so far, bond market is up 2 days in a row since that House bill passed, right? The Treasury bond market is up. That's a big sign to me. We'll see if it continues, but it's a big sign to me. And a deficit is technically stimulative to the economy because that's $2.3 trillion that will be going into the economy in total, right? Now, unfortunately, when you do these tax cuts and it's lopped higher towards the higher earners, they pay more in tax and whatever. But the key problem from an economic standpoint is that they tend to not spend it.
The growth is less trickle down than expected usually.
Oh yeah, the trickle down concept has been, hasn't worked. And so versus hey, you give more money to that bottom 20%. You really want to stimulate the economy. You would do that. And that's essentially what happened with that $1.9 trillion bill that was done, that COVID relief bill, was funneled down towards that lower end of the spectrum, in terms of income-wise, and we ended up with inflation because of that, because they were out spending that money, versus you give it to a bunch of people that have a lot of money, they tend to put it in the stock market, which would help the stock market some, or save it and what have you. So. But overall, the stock market's going to look at that tax cut bill as positive as long as that deficit is something that is amenable, right?
Yeah.
And I think at 3.8 trillion, didn't like it. Bond market didn't like it. Stock market didn't like it. At 2.3 trillion, so far,
It's okay.
Yeah, I think the stock market's coming down right now because of what's happening with the EU tariffs and Apple and that kind of stuff. But I think it's okay. So that would be my biggest takeaway from it. It does have some potential to help the stock market here as far as that goes, and we'll see how much that deficit actually turns out to be. That's my fear, because in the past, 2.3 trillion projected deficit turns out to be much higher than that.
Yeah, and the thing is, we're still not at the final iteration of this bill. It has to go through the Senate. What gets cut or added by the Senate is going to go, and then it has to come back to the House to get revoted. And so it's one step forward, but we don't know what the end result will be.
Yeah, well, we do know that they're trying really hard to keep the campaign promises, the tax on tips, tax on overtime, Social Security taxation, not keeping that promise exactly, but there'll be a $4,000 additional add-on to your standard deduction
Yeah.
if you're over 65, right? And they're trying to keep the 2017 tax brackets in place. Unfortunately, if you do all of that, you're got to cut someplace else pretty heavy, and some of
Yeah.
those areas are
And I
things that
think
people
Medicaid
like.
and
Yeah.
SNAP programs are
Right.
probably going to be what's on the chopping block.
Yeah, that's right, exactly right. And so that's a brutal trade-off, at least from a social or societal standpoint, or even from a polling standpoint. I think it's really high. I think it's like 70 to 80% of Americans don't want to see cuts to Medicaid. So that's why they're burying them in to start after the midterms at this point in time. So I don't know how they're going to close that deficit from the 2.3 trillion lower, even in these itinerations, because they're not willing to give up on the cuts. Those were promises made, fair enough. And so the only way they can bring it lower is actually make more cuts and bring Medicaid higher, whatever else they want to throw into the mixture there.
Is it defense spending? What other?
Yeah, well, they're adding 150 billion to the defense funding. So that always gets added to. It's an interesting area. I don't know enough about how defense funding works and where it goes. I know just to keep prepared for action, it's really expensive. I mean, all the maintenance and all the training and all those things. So, and that's important to our overall security and such too. But yeah, it's an interesting bill. We'll see how it plays out. But I think the market would like it.
What effect could Japan's surging bond yields have on the U.S. bond market, or just the U.S. market in general?
Yeah, so it's pretty unusual actually. Japan has so surging yields means that their bonds are dropping, right?
Yeah, people
And
don't want to pay for their bonds.
people want to buy their bonds, or they're selling more than they're buying, or whatever it might be, right? And so the yield ends up going up, and they can try to intervene on that, which they've done in the past. They do different things, but I guess two things come to mind. Number one is, Japan is a potential substitute for safe money, in theory, although I'm not sure that's as true right now. But if their bonds are paying more and they get up high enough, people will start buying their bonds, possibly more money that might have been coming into the U.S., right, could go into Japan. It's that kind of economy where you could make that decision as far as that goes. Maybe not for everything, but so it's a competitive asset to the U.S. bonds. I think more importantly, though, is what it says about Japan, and when it feeds into my biggest fear. I specifically remember 2008, and boy, I remember just the pressure that was placed onto the overall system and how things became illiquid and how every asset class dropped. You got gold, it didn't matter what you had. It all dropped. Bonds dropped. And so when you put pressure on a system, something could fail. And so when you look at what's happening with Japan all of a sudden, that's what the alarm bells in my head start to go off a little bit and say, oh, what if something happens for Japan's liquidity or something, because it can start anywhere. My bigger concern has been China, because they were kind of struggling with deflation and all kinds of things before, the whole, tariff thing even started. But now you're seeing some things happen with Japan, and, you're having Jamie Dimon and the CEO of Citibank running around saying, hey, look behind the scenes, things aren't going that well. And these are the same people that were saying those types of things, and I've been saying those type of things. And so I think that to me is the bigger issue, is just, what does it signify, and is it a danger area? Because
could this be the contagion to the rest of the world?
Yeah, heck, Russia defaulted on their debt in 1998. What connection do we really have with Russia economically? And their economy is as big as Florida, and so, but the market dropped like 20%. And there was one company, a hedge fund, that was massively leveraged against Russian debt. And it was really unprecedented. Greenspan had to step in a meeting and bail that company out, because everybody was freaking out. And they all contributed. Merrill Lynch, all the big firms, because it was like a house of cards. It was about to fall apart because Russia defaulted on their debt. What if Japan or China defaults on some? Okay, so we aren't going to get away from that on an economic basis. So that's where that surging yield on Japanese debt probably has a bigger impact, potentially impact on the U.S. Is just any place that whatever happens can happen anywhere, and oftentimes it's not something we're talking about. That's been the truth in the past.
Yeah, because Japan's kind of like the U.S. They're running a deficit, but they have the highest debt to GDP in the world at 234%.
Whew. Wow. Yeah, that would cause your debt. Yeah, but how do they do that, right? How do they keep doing that? They're adding, because it's getting bigger, and just like ours, they're probably running a deficit on a regular basis, and it's getting bigger and bigger. I mean, what percentage do you get to where you have to default on it or restructure it, or how do you get out of that? So that, again, those are the things. Well, Greenspan had that great saying, right? When the tide goes out, you can see you swimming naked. So the tide's being pushed out by these tariffs and other type of economic, trade scenarios that are causing problems. And all of a sudden, you find out who's really struggling and who's on the edge already that could get pushed over that edge. So, yeah, good question. I think we have time for one more.
So how do you avoid capital gains tax on appreciated real property like a condo or a house?
Like a rental or your personal place?
So let's kind of be generic and let's go across the board. So let's start with rental and kind of investment properties.
Well, and in both cases, taxes can be avoided if somebody passes away, right? Which is probably the biggest penalty you can possibly pay. But there is a thing called a step-up basis. And so your house, whether it's your house or your rental home or condo or whatever, would get stepped up in value to the current value at the date that whoever it is was one of the owners dies. So it could be your spouse, you and your spouse own this house or what have you, and the house would then get stepped up. You might have paid, very little for it compared to what it's worth now, but and so it wipes out the whole capital gain. If you had to sell it right then, you could do so without the big tax hit. So. And then if it's commercial property, like a rental or what have you, there's a lot more options.
Yeah, you can do a 1031 exchange where you kind of sell that property and you just buy another. So essentially, you're not eliminating capital gains, but you're basically deferring it to another sale.
Right.
And then the end goal when you ever defer is step up. Basically you keep deferring until you get stepped up is really what a lot of these tax laws is. So you also have 721 exchanges or UPREITs, which are kind of like the idea is you sell to a REIT company, they manage the property for you, and you get REIT shares in exchange, so you don't have to actually do that active management anymore.
Yep.
But the thing is, what is the purpose of the sale? Is it to get access to the investment? Are you looking for income? Because if you're looking for income, you always have those charitable remainder trusts, whether there's charitable remainder annuity trust, you have charitable remainder uni trust, and so those are ways you can get income. You get a tax deduction for whatever ways you get it, and you can have income for the rest of your life or a 20-year period.
Yeah, we've had clients take their rental properties and they're getting older and don't want to manage them anymore, but they have depreciated them down to basically zero, and so the gains would be high. So they place the property into a charitable remainder unit trust, for example, and they choose some charities that are going to get the value of that at the end, and then they set up a distribution. 6 to 10% is roughly the range I've seen. Higher. You actually get a write-off for contributing this thing, but if you take more income, you get less write-off.
Yeah, so the idea is that it allows you to sell while avoiding a bulk of the capital gains.
And still get some income from it, which is what you were getting from your rental property. And you probably weren't getting 6% from your rental property.
The only problem is once at the end of this term, whatever's left goes to the charity.
That's
so
right.
Essentially, with a rental property, if you stop renting it, you still have an asset at the end of the day. You lose that asset when you use these kind of charitable remainders.
Exactly. So if you have beneficiaries who you really want to have receive this property and you put it in a charitable remainder unit trust, they're not going to get it. It's all going to disappear upon your demise, and the charity then gets the remainder that's left over. So it depends on the situation. We have clients that don't have beneficiaries that they're that concerned with for whatever reason, and so it works kind of well. Sometimes you got lots of different properties and you just want to take this one
Out of the market.
out of the market, and so there's some reasons to do it. But yeah, there's quite a bit to talk about there in terms of what you could do.
Yeah, and I think the solution for you is a very specific, based on what your needs are, what your wants are, what are you trying to avoid, and what capabilities you have. And so I think for one of these questions, it's always best to talk to a professional, at least, and then your tax professional as well too.
Yeah, no kidding. Don't jump into that pool without knowing how to swim. So, all right, that's our show today. Really appreciate everybody coming. We will be here again next Friday. Look forward to that. Please send in your questions now, this week, so we can take a look at them. Again, it's Ask Tom at talkmoneywithtom.com. We'll try to answer those next week. Of course, you can subscribe to our channel, continue your educational process here in terms of how to handle your finances and your retirement. And then lastly, obviously, you can meet with Ethan and I if you'd like. There's a book appointment button on our website. The link to the website is right here on the channel. And set up a half-hour time to talk with us about your questions. And anyway, look forward to seeing you again next week. And thank you for coming.